Today, we're having a look at what two different banks are saying. Firstly, we're going to have a look at Goldman and what their thoughts on equities are going into year end. And then we're going to have a look at what ING have been saying, the big Dutch bank, about oil and how oil finished lower yesterday and what that means going forward. Today's Trading Takeout is going to be on why losers are actually really, really important in context of your whole entire trading. Now, the only way you can get the best trading insights, education, and analysis each day is if you're here every day. So hit subscribe so you can get your daily trading edge. So this is from Scott Rubner, one of the key analysts at Goldman in the flow of funds space and equities generally. And he's got some interesting perspective here. And this is institutional research, by the way, so I'm only going to show you a small bit of it. But effectively what he's saying is that the market is now poised for a grind higher into year end. What we've seen in equities so far over the last week or two has been a lot of short covering. But the big point here is that just because it's been short covering doesn't mean that it can't continue and it can't turn into motivated buying effectively. So what's he saying is the bottom line in discussions with clients has been, was that little rally all we got? No. Are we higher from here? Yes. I think the market's become more of a grind, not a gap into year end. That was enough for the cover bid, but higher prices bring out more buying, which makes perfect sense. The change in price changes the narrative effectively. It changes how people think about the market composition, what is going on in the market. And considering it's largely algorithmic these days, a lot of momentum algorithms are going to pick up on this. And they're going to keep buying anyway. So this is what he's talking about with regards to the grind. The market flow of funds technicals, which have been a headwind for all of all of Q4, now become a tailwind, so a support basically. A bullish setup is developing for the 60-40 portfolio, so effectively long equities and I guess long bonds as well. This is beyond short covering. Year-end rally blueprint, recession in name only. The bigger they are, the harder they fall, or the smaller they are, the harder they rally. These are 10 points that I'm tracking today. And then he goes on to list all of these. We're not going to get into those because they go way beyond what we're talking about here. But effectively, this is what a bank like Goldman is setting up for. Goldman aren't always right, though. I remember back in 2018 or 2019, they had 5 trades that they would release for, the very start of the year. And within the second week, they were all blown out. So we have to pay attention to really okay, this is sell-side research. And these guys aren't necessarily trading. They don't care really about where the market goes. And it's probably in their interest to say that the market is going to go up. It induces more buying. Goldman, a massive, massive bank. They've got a massive research team. However, I don't think necessarily that there's no merit behind this. I think that he's bang on with regards to, the extent to which the market's already gone higher and how it can grind up. The one thing I will say is that geopolitical sort of sensitivities are a lot higher right now. And when you get exuberance like this from large banks, I tend to think, okay, what could be an event that really ticks them off? Could it be that we jump into a very quick liquidity crisis? So that is what I would be watching out for. But the problem with that is that you can't tell when they happen. So it's largely one of these things where you just have to sort of factor in, okay, what is the risk to reward up here? I'm not a fan. I hold the S&P 500 passively. I don't actively trade it at the moment because I just don't know enough about or have enough confidence about where it's going, really. But you might. So it's interesting to take this view into account that we could have a grind higher based on the short covering that's led to higher prices so far. Now, oil and ING have some interesting things to say about oil. I can show you more of this one, and it extends down into gold actually, but we won't get into gold today. I can show you more of this one because I believe it's more open. You can read more about it. But effectively, what what ING is saying is what I've been saying for quite a while, is that demand just isn't really there. And remember, we were talking about that escalation, de-escalation thing. It seems like the troubles in Israel-Palestine have not escalated any further whatsoever. It's the same stuff that is just going on. Unfortunately, airstrikes, etc., etc. There's no real ground invasion or anything like that. It's a humanitarian disaster, of course, but in the context of markets, there is no escalation. And so this is really what we are looking at here. And they highlight the demand side of things as well. They say, and while there are clear demand concerns hovering over the market, supply dynamics have also played a role. For example, Russian seaborne crude exports have grown in recent months, which suggests that Russia is not sticking to its additional voluntary cut. You could take from that Russia needs cash, basically. I think, they're looking also at how fast will OPEC cut, and they mentioned that here. The recent price weakness is likely to lead to growing noise from OPEC and in particular from Saudi Arabia. While Saudi Arabia and Russia confirmed that they would continue their additional voluntary cuts through year end, it's increasingly likely they will extend this to the new year if downward pressure continues. So demand is literally just overcoming supply, basically. The lack of demand, or I should say, is overcoming supply. And this is troublesome for, as it says there, the Saudis, because they basically need to make revenues from their oil. Otherwise, they're not really making money from anything. And so, this is why I think the oil market's in a very interesting place. It's in a very, very interesting place right now. More interesting than it has been for about a year and a bit, considering where oil traded last year when we were having the energy crisis. So, this is something to bear in mind, that we're at a battle currently with demand, and this also feeds into the recessionary fears as well. If there's no demand for oil, there's no demand for manufacturing, production, etc. And we've seen Germany's manufacturing numbers get absolutely smashed to bits recently. So they're another country that is proving the demand thesis here. They're proving that demand is flattening, and it doesn't look like it's picking up. You can look at the forward curve on crude, for example. It's in backwardation. So backwardation is when futures prices are lower than the current price. And I've mentioned that over the last couple of weeks to months as well. So real issue there in energy. A good issue for us, though, as economic participants. It means our fuel bills are likely to come lower. But in terms of energy bulls, they're a bit stuffed here. The demand side of things really, really is flattening that curve, meaning that energy is going to struggle to get higher prices. A lot of people refer to trading psychology as being absolutely paramount, but I think there's a good way to flip this, and it comes down to understanding that losers are just a part of business. Say you own a shop, okay? You need to buy stock for that shop. Right away, once you've bought that stock, that's effectively a loss, okay? And you're betting on being able to sell that stock for more than you bought it to cover your costs, pay yourself, etc., etc. It's exactly the same in trading. The second you enter a trade, you've got to consider that is just a cost of doing business, a cost of entering to try and make use of the fact that you've got risk on the table. That is all it is. If you can start to get that into your mind, you won't be so afraid of losers, effectively. Losers are a great part of business because they're just showing that you're enabling yourself to have some reward over the longer term.